Neural networks can leverage detailed data sets and capture complex, nonlinear relationships, providing valuable insight during periods of rapidly changing inflation dynamics. AI also supports financial stability analysis by identifying patterns in large data sets and assessing risks across financial and non-financial firms. For example, during low liquidity and period of market dysfunctions, AI supports predictions by monitoring market anomalies. 3, payment system oversight and global connectivities. AI is transforming payment systems by enhancing safety, efficiency, and compliance. Tools like graph neural networks improves fraud detections by identifying suspicious transaction networks, especially when data is securely pooled across institutions or jurisdictions. Another example is in correspondent banking, which faces challenges from compliance risk and so on. There, AI could enhance anti-money laundering and know your customers processes, reducing risks and their associated costs, which may restore global payment connectivities. By pooling payment data across jurisdictions, AI strengthens cross-border fraud detections and compliances. Around the world, central banks are also adopting AI to enhance payment infrastructures. For example, in the BIS Innovation Lab, several central banks, including Bank of France, Bank of Japan, Bank of Korea, and Swiss national banks, are collaborating on the project called Agora. This project leverages tokenizations to implement the next generation's correspondent bank. Beyond the focus on the core features of the unified ledger, AI models may be used in the future to improve efficiencies in compliance practices. Let me now turn to the challenges that central banks face in their policy operations. While the benefits of the artificial intelligence are undeniable, it is integrations into central banking present challenges as well, particularly in the monetary and financial stability area. Here are some of the pressing issues. First, the key technological limitations of AI. For example, despite advancement, AI models face challenges such as logical reasoning and counterfactual thinking, struggling to adapt when familiar problems are rephrased, which highlights a lack of true understanding. A major issue is sometimes called hallucination, where large language models generate confident but incorrect information, where they predict plausible text rather than ensure factual accuracy. Many AI models, particularly proprietary ones without open source frameworks, functions as opaque black boxes. Their lack of explainabilities poses challenges for their applications in monetary policies and financial stability decisions. Further, the black box natures of AI models raises concerns about trust, accountability, and compliance with ethical guidelines, compounded by legal risks around data qualities, privacies, and confidentialities. Additional risk, referred to as third-party dependence, emerge from reliance on few providers of advanced AI models, driven by high cost of developing and deploying data-intensive systems. So I can move on and on. The list is quite long. Second, monetary policies and transmission effectiveness. AI is presenting challenges to monetary policies and its transmissions mechanism, as highlighted in the recent ECB report and the BIS annual economic reports. The AI is poised to reshape labor and capital markets, influencing income and wealth distributions. This has significant implications for monetary policies. It affects the marginal propensities to consume, consumption patterns, and access to credit, all of which shape how demand responds to monetary policy changes. The AI-driven algorithmic pricing enables faster and more flexible price adjustment. For instance, large retailers can quickly respond to changes in gas prices, exchange rate, and other shocks, particularly amplifying their impact on inflation. And fast price adjustments may also reduce the lag between the policy actions and their impact on inflation. AI-driven investment and productivity gains could change the speed and the way firms and households respond to interest rate changes. So all of these have potential impact on how monetary policies transmitted into the real world. Furthermore, if AI drives any shift in financial structures, such as increased non-bank intermediations, it could also alter the transmission of monetary policies. Non-bank, compared to traditional banks, are more responsive to measures targeting long-term interest rate, such as asset purchases and trend to carry greater credit, liquidity, and duration risk. 3, financial stability risk. The integration of AI into financial system also present financial stability risk to central banks and policymakers. For example, AI's rapid real-time responses may increase volatility and herding behaviors, which create destabilizing feedback loops. Liquidity risk may also arise. AI models might prompt widespread liquidity hoarding and trigger fire sales and further destabilizing the market. As institutions increasingly rely on AI and reduce dependence on human expertise, the widespread use of similar algorithms could amplify market movement. For instance, if numerous institutions adopt comparable AI models for credit risk, trading, and portfolio management, synchronize the responses during the period of stress could exacerbate pro-cyclicalities and triggers large-scale asset sell-off. And algorithmic collisions is another risk. AI trained on similar datasets may unintentionally produce the coordinated recommendations or pricing strategies, mimicking collusions and undermining competitions. Traditional regulatory frameworks may struggle to address these challenges. 4, cyber risk and ethical considerations. Cyber criminals are increasingly leveraging AI to craft more seemingly convincing phishing emails, develop malicious code, and mimic voices or writing styles. This has fueled a surge in phishing, fraud, and ransomware attacks. Additionally, AI introduced the new and evolving risks, such as prompt injections and data poisoning, which can compromise training data and undermine the integrities of the system. The ethical use of AI is also crucial to maintaining public trust. Central banks have the responsibilities to ensure that AI systems are transparent, fair, and free from biases. However, AI systems can unintentionally reflect biases present in their training data, potentially leading to unfair outcomes. For example, algorithmic discriminations in credit scoring could exclude certain groups from accessing financial products, thereby exacerbating inequalities. So in this regard, I'm very pleased to learn that the Reserve Bank of India has acted very proactively by promoting ethical and responsible use of AI. It recently released a free AI framework to secure the responsible use of the AI. AI also raises significant concerns regarding privacy. The misuse or abuse of sensitive information poses serious risk to individuals. Financial institutions and AI providers must adopt and adhere to strict privacy standards to safeguard personal data and uphold public trust. So I have discussed the benefit and challenges that central banks have faced within the use of the AI. Many times, however, central banks face complex trade-offs that demand careful considerations. For example, one of the key decisions revolved around choosing between external and in-house AI models and data sources. External models and commercial data vendors provide cost efficiencies, rapid deployment, and access to private sector expertise. However, they come with challenges such as reduced transparencies, increased dependencies on limited number of the providers, and stricter usages of restrictions. On the other hand, in-house models and curated internal data offer greater control and adaptabilities, but require significant investment in infrastructure, skilled personnel, and robust governance framework. Another challenge lies in balancing speed and accuracies. AI abilities to enable rapid, real-time analysis is invaluable for timely decisions. However, the speed must be tempered by effort to mitigate risks such as hallucinations, biases, and vulnerabilities. While the potential of AI to automate routine tasks and enhance efficiencies is undeniable, human judgment remains indispensable. Central bank must cultivate teams with a balanced mix of economic expertise and technical skills to effectively oversee and interpret AI-driven insight, ensuring that human oversight complement technological advancement. Let me now turn to the role of the BIS in supporting central banks. At the BIS, we support the central banks through three main avenues. First, forum for discussions. We offer space for central banks to exchange insight and build communities around emerging technologies. For example, our research conferences, workshop, network explore research frontiers and provide knowledge on their implications for central banks. Second, we work as a platform for international cooperations. We facilitate cooperations among central banks and regulators to uphold monetary and financial stability. Through committees such as Basel committees on banking supervisions and committees on payment and market infrastructures, we address challenges and opportunities posed by the digital revolutions, including AI, together with the central banks. Three, we work as experimental innovations platform. Through BIS Innovation Hub, we enable central banks to experiment with cutting-edge technologies. For instance, Project Aurora uses AI to enhance suspicious transactions monitoring across firms and borders. So dear colleagues, let me conclude. AI presents transformative opportunities for central banks, enhancing efficiencies, decision-making, and financial infrastructures. From advanced data analysis to improved oversight of payment systems, AI is already reshaping central bank operations. However, challenges such as data qualities, model complexities, ethics concerns, and financial stability risks must be carefully addressed. To fully realize the potential of AI, central bank must balance its benefit with its risks. Transparency, robust governance, and talent development are essential to navigating this evolving landscape. As steward of monetary and financial stability, central banks have a responsibility to adopt AI in a safe, ethical, and sustainable manner. The BIS is dedicated to supporting this journey by fostering dialogue, promoting international cooperations, and enabling innovations. With that, I thank you.